Ladies and gentlemen, welcome to Destination Retirement with Robert Kuhn.
Time to get on board with Robert Kuhn from Kuhn Capital Partners. Retirement is a destination you've spent decades saving for. And what you do with those savings can make all the difference in the life you live once you get there. Income planning, wealth planning, tax planning. Destination Retirement with Robert Kuhn starts right now.
Welcome. I want to thank everybody for listening today. My name is Robert Kuhn, president and founder of Kuhn Capital Partners. You're listening to Destination Retirement. We have done so many shows, and I love the fact that we podcast every radio show, and you are free to go back all of our shows and listen to shows during different periods of time in the market. I think when you're on the radio, I think it is phenomenal that it gives you a timestamp, and generally we say the same thing over and over and over again. And it's something that we're very, very passionate about. When you look at what the financial advice business has become, it's unfortunate in my opinion. I think it's buy and hold, cookie cutter, and that's just an issue. Well, it hasn't been an issue because the markets go vertical, but nothing is an issue when the markets go vertical. At some point, the markets will not go vertical, and it will benefit you to have strategies that are just not buy and hold. So thanks for listening this week. If you'd like to get on our calendar, you can certainly do that by calling 630-492-1912, 630-492-1912. And we will have an initial conversation. You'll have a conversation with somebody from my team. And as you know, we do, I guess I would consider it cutting edge strategies, even though unfortunately, maybe they're cutting edge for many advisors, but it's certainly not cutting edge for us. We've been doing the banknote strategy for an extended period of time, and very pleased to see that people are actually going to the new website, the redesigned website. We have some videos. We have really education again, because I think, at the heart of everything that we do, it's to educate the investor on ways to allocate capital to strategies that can have some sort of a defined outcome. It could be a growth, defined outcome. It could be a downside defined outcome. It can be a combination of the two. But buy and hold and looking at 100 years worth of data and 100 years worth of charts, I'm not quite sure is very relevant in today's market. KUHNCP.com, KUHNCP.com. So if you prefer to check out the website first and watch a few of the videos, whether it's on the energy strategy, on the banknote strategy, we're updating the hedge fund strategy as well. If you'd like to watch those videos first and then decide to reach out, you can do that on the website, so KUHNCP.com. But we're very pleased with the response and the reception and the numbers of, how many people are going to the website, et cetera. So we are headquartered in Oak Brook. So if you have not visited us, or if you don't know that, we're headquartered in Oak Brook. We do have a rather diverse client base across the country. Last time I checked, we were advising on close to $200 million in 24 states for, 400 or 500 clients. So that's, really pleasing to see. Certainly it's nice to see any business grow. Certainly one that you're, in charge of and kind of the captain of the ship at. But more importantly than the growth and what it does for us selfishly, it's really the education of the investors that we're able to help. And that's something that we're very passionate about. That's something that if you want cookie cutter, if you want a 10-question risk profile questionnaire, and then to do a cookie cutter 60-40, 70-30, set it and forget it strategy, we're certainly not going to be the group that you're going to want to work with. There are plenty of firms, most firms I would envision, at least that's my belief, that you can do that. And believe me, it's so much easier for the advisory firm to run a clientele that way because it just doesn't require a lot of work. And the reality is you're going to be right more times than you're not going to be right because the markets go up on average more times than they go down. But I guess right is all relative, and it's what you're looking for. And in this radio show that we do podcast every week, it's we try to share with you kind of the pitfalls of what to look out for. So that's who we are. And if you've listened to us for an extended period of time, you know that. Banknotes are still pricing really strong. Very, very pleased with that. The index income type notes are still 12 to 14%, depending upon the bank, depending upon the index, depending upon when we price it. We had a tremendous amount of activity and interest in, I called it the Mag 7, mini Mag 7, but it was really Mag 3 because it was 3 stocks. I believe it was Amazon, Google, and Meta, so Facebook last week. That note ended up pricing, we said around 20%. That note actually ended up pricing around 20. Well, I think it was exactly at 22%. So I think that strikes, maybe it already did. But anyways, we locked in the pricing at 22%. And so, investors today love strategies that there's a defined outcome. And when you talk about defined outcome, what does that mean? It really just, is that we know the rules of the road going into the strategy. We know the rules of the road before we invest in it. And with the bank notes, depending upon, which note that we're using, we know that there's either 30% downside before you don't get paid a coupon payment. That is really simplistic. If any of those stocks go down 30%, then you don't get paid your monthly coupon. So they look at it every single month. And on the principal side, if it were to go 5 years, which, anything can happen, certainly, that is, I guess, the sun could not come up tomorrow, but it's, anything can happen. But if it did go the 5 years and it was down either 30 or 40%, in 5 years, then we could, have to have a conversation about getting back less than the initial principal. Now, hopefully we collected, coupons along the way. So in a catastrophic scenario, maybe you're looking at break even to slightly positive, but these are the strategies that we are utilizing that other advisors don't. Look at what the fixed income market has done. So the Mini Mag 3, note we're going to continue to price between, the 7 names and mix them up. If you want to take advantage of that, we price them on the fly. And so I would encourage you to, get an account open, get the account funded at Charles Schwab. With our assistance, it goes underneath our master account number, so we open it for you on your behalf. And if you have other Schwab accounts, it'll link it so you can still see it there. But you don't want to wait until we announce one, because you're probably not going to participate in it, because it takes a little bit of time to open the account and then to fund the account. So 630-492-1912, 630-492-1912. We did hear that AT&T, again, I don't know this to be correct other than the clients that we work with here in the Chicago area, they are offering some or all, again, I don't know, a early retirement. We do have many clients that work for AT&T, and so if that is accurate and you have been given some options, allow us to run a financial plan for you, allow us to help you in your financial planning process. If you need help making a decision, whether it's appropriate to accept it or not, we'll certainly do that for you as well. 630-492-1912. Again, when we are looking at financial planning, we are big believers in Roth conversions, and really Roth conversions for multi-7-figure IRAs, where most advisors have told you that it doesn't make sense due to the taxes, because generally if you have a $1 to $10 million IRA, you're generally a higher wage earner, and it may not make sense. But if you have an investment in the that can reduce the taxable income, which our Bison Funds does provide. Again, as a reminder, in our energy strategy, we target 80 to 90% per your investment of tax benefits, active or passive. So it can reduce your tax benefits, active or passive. income. Again, not tax professionals. I want to be very, very clear about that. This is simply for educational purposes only, but you can put in ChatGPT or your favorite AI engine, give me the tax benefits of oil and gas investing, and you'll see that I don't think there is a better strategy out there if you're looking to reduce taxable income. So bring your CPA in, your tax preparer, no problems. We can have those conversations with them as well. But 80 to 90% is our target. So for every 100,000 invested, 80,000 to 90,000 can reduce your taxable income. So it's the usual suspects inside of our funds that you would believe: high wage earners, physicians, et cetera, business owners, individuals who have had some sort of a liquidity event, whether it be a property or a business. But also, I want you to think about if you have a large IRA and you want to do Roth conversions, and you can contribute to the Bison in Bison funds with outside money. We may be able to look at a conversion strategy over 2 to 5 to 7 years if we have a fund a year, which we envision that we will, but nobody knows the future, obviously. But these are the things that we're doing that most advisors are not doing. And just when you compare, those two strategies alone, the banknotes and the Bison strategy, that puts us in a category of very, very few advisors. And we like that. And we do this, and it takes a lot of work, and it takes a tremendous amount of administrative work on the banknotes when you do them at scale like we do. I don't have the updated numbers, but I think we're over 100 million for the last 17 months year to date. We might be 45 million ish, but our goal was 100 million in new issuance for 2026, and it seems like we're on target for that. Again, it's just unique. It's just different. And the problem with the financial advisory space, and we're going to talk a lot about that this show, is just lack of education from advisors. And then when an advisor hears something that I talk about on the radio, and you ask your advisor, inevitably they say, well, it's not good or it's bad. And it's like, what? It's just crazy. And we'll share with you kind of some stories, because again, we like to pull back the curtain. I love doing the radio show. I love sharing with you this crazy industry, and we're just going to keep sharing the stories, as long as we can, keep doing the radio. So 630-492-1912, 630-492-1912, or visit the website, KUHNCP.com, KUHNCP.com. More after the break.
Retirement looks different for everyone. Will you be sitting on your porch taking in the view, or will your porch be disappearing in the rearview mirror? Whatever your retirement dream, making it a reality starts with a plan. Robert Kuhn at Kuhn Capital Partners can help you create a financially secure and tax-efficient plan that is tailored to you. After all, you deserve to live your dream. Call 630-492-1912 and start planning for tomorrow and every day after. 630-492-1912 and visit us online at KuhnCP.com.
Welcome back. You're listening to Destination Retirement. My name is Robert Kuhn, president and founder of Kuhn Capital Partners, also managing general partner of our private funds. So we have several private funds that you have to be accredited to invest in. But obviously the energy strategy can greatly reduce your taxable income. Really proud to say that, many people, we didn't really start talking about the energy strategy on the radio probably, a few months back. Maybe we've made it more of a prominent spot on the radio, and a lot of people are calling in, for that, and I love it. And investors will always ask, what's your minimum investment? And we like to say 100,000 because it's just easier that way. But again, it's really what benefits you, and it's never our agenda. It's always your agenda. And what we look for mostly is investors that will have a tax need year over year, because if you're going to have a tax need this year, you may have one next year, you may have one the following year. And it really truly just helps the capital raise to, hopefully fund the entire fund in the first 2 quarters of the year. because that's when deals are meant to be had in oil and gas. Everybody is looking for assets and deals, in the fourth quarter, because everybody starts thinking about tax reduction, in the fourth quarter. Well, deals are hard to find, and including, the assets that we sell. We're not giving deals. I mean, we're marking up those assets as much as we can to the benefit of our clients. And so, but for those of you that have reached out, especially if you're a higher wage earner that can utilize the tax benefits creatively, we just want to say thank you. So 630-492-1912, 630-492-1912, or visit the website kuhncp.com, kuhncp.com. There are some videos that you can only get access to on the banknotes and on the energy strategy if you call in. And so if you want to learn more about it, either of those two strategies, certainly reach out and we'll do that. So U.S. stock market is now the most overvalued in 50 plus years. What a headline, right? We've had a pretty, interesting debate in our office going back and forth with, the level of concentration you should have in a portfolio. And most advisors, unfortunately, are going to, again, stick with that asset allocated model because it's easy. It's easy to run. It's easy to explain. It's just easy. And easy doesn't always mean it's right. And I've never understood, those advisors on the radio or TV or whatever that, come in and say, you can't time the market. Well, what is timing the market? I mean, can you time the market tick by tick? Well, there are people that do that. And they're very successful at it. The reality is they don't need our money. And so they're probably doing it with their own money. But what exactly is timing the market? Does that mean that you can't play defense? Does that mean that you shouldn't have strategies like the banknotes, for example, that, provide you a 30% downside buffer before you don't get paid, a 1 to a 1.25% monthly coupon payments? That's, backed by, the JP Morgan, Citis, Goldmans of the world. I mean, I don't know. I mean, that to me is kind of crazy, right? We always talk about what level of concentration you should have. And the reality is, my belief, concentration creates significant wealth. The reason why the financial advisory space, does not believe in concentration, advisors believe in concentration, is because the compliance side of it is you're just kind of leaving yourself out to hang. I mean, you're, a potential, lawsuit or arbitration away if you have, high levels of concentration inside of a portfolio. If the markets don't go up, you're going to have issues. And so to me, it's like, well, how are you allocating capital in a client's portfolio? Because I think, if you have some level of concentration that's offset by some level of defined outcome or like the banknotes or, income that's going to come in with, very little correlation to the S&P, like the banknote strategy, well, then maybe we can have 5 to 10% or 15% of the portfolio in a, highly concentrated portfolio. And that's what Bison Alpha is. And that's what the hedge fund strategy is. And you do have to have 2.1 million, I believe, or $1 million with us at the firm to invest in it, not including your primary residence on the $2.1 million side. But I look at a lot of our clients, for example, and I look at, clients that, we looked at last week, we had clients that, are up 3,000, 3,500, 3,800% on individual stock names, over a 10 to 15 year period. And I mean, it's just amazing what level of wealth, some level of concentration has created. And what Bison Alpha is, it is a concentrated strategy in the best names that we believe are going to provide the most amount of growth going forward. Is it over the next quarter or two? I mean, maybe not. But if you have a really kind of a 4 to 6 year time horizon for that money, why shouldn't you take a level of concentration to, try to create significant wealth? And again, that's what we do that's different in that, we have other strategies that if the markets do, go down, like that headline, the U.S. stock market is now the most overvalued in 50 years, or the 10 largest U.S. stocks now account for 41% of the S&P 500's market cap. I mean, that's 14 percentage points higher than the dot-com bubble peak. And that means 41 cents out of every dollar invested in the S&P flow directly into shares of just 10 names. That is massive concentration. And there's going to be a period of time that, it goes down. And when you're an individual trying to have levels of concentration, unless you have permanent, I don't want to say permanent capital, but consistent capital coming in that you can buy at lower prices, yes, the risk is probably, significant, and it may not be something you want to look at. But the benefit of investing in a fund like Bison Alpha, again, it has a PPM, it has a subdocs that you have to look at, and read and make sure that it's appropriate for you and whatever your investment thesis is. But when we are basically dollar cost averaging on your behalf, you're able to buy the dips with both hands, assuming, of course, those names are still, the names that we believe are going to be, standouts. But, that's the way to look at it. Unless you have, consistent capital that's coming in for you to buy the dips, you have to look at utilizing a fund like, of course, ours, Bison Alpha, or other funds that have that, discipline and philosophy that when the markets are down, we're okay with it because we're buying more, assuming, of course, we have capital coming into the fund. If we don't have capital coming into the fund, then it's just like we don't have consistent capital to buy at lower prices. But, generally that hasn't been an issue. But of course, we don't know what tomorrow will bring. But that's something that I really wanted you to think about. And so it's, something that we didn't articulate it in that way. And, we're very pleased that we're starting to articulate it in that way. And because there's tremendous amount of wealth that can be created. And you have so many people that sell fear, and I've heard over and over again. I was listening to, one of the podcasts that I absolutely love on a weekly basis, the All In Pod, and you can listen to it. It's great. And the level of concentration for, higher net worth investors now, they may not have the same risk return profile as you or time, et cetera. But generally, wealth is created with a level of concentration. But you have so many people on the radio that are just selling fear, and selling these lifetime, index annuities that look really, really good on paper, but, just have very little growth. I mean, almost no growth. And other than the illustration, other than what they showed you going into it, and because it was back tested, it was computer generated. And so when we look at that compared to, the bank notes, any way you look at it, in my opinion, whether it's immediate income, I mean, obviously, short of the market crashing and staying down below that buffer, I mean, it's probably going to be a better cash flow story. If you're looking for growth over the longer term and not taking income for 3, 5, 7, 10 years, there's almost no comparison. And so for those of you that own those lifetime income annuities, for those of you that own or are being sold those, we need to have a conversation. I mean, if you bought one and there's been no growth and there's a big surrender charge, let's talk about, a strategy that can get you out of those. And it may take a year, it may take 2 years to ultimately, pay off that surrender charge with, the banknotes, for example, assuming they're paid, of course, and that the markets don't go down significantly. But it's, those are, certain conversations that we're having. So 630-492-1912, 630-492-1912, KUHNCP.com if you want to check us out on the website, KUHNCP.com. But, that's what we spend our day, really talking about. And we're just could not be happier with how the banknotes are going. Could not be happier with the pricing. Could not be happier with the big banks. And really just could not be happier that, clients are saying, let's start with the little and utilize you as kind of, we two types, obviously. I would say the majority of our clients, we manage 100% of their money, and that's not all of your eggs in one basket. I guess that's all of your eggs in the Charles Schwab basket because that's who our custodian is, but it's certainly not, the single strategy. But a lot of people will say, let's use you as a satellite. Let's use you, for the energy strategy or the banknote strategy or the hedge fund strategy. And then, as we get comfortable, we move over more money. So, and we're perfectly okay with that as well. So 630-492-1912, 630-492-1912. More after the break. Welcome back. You're listening to Destination Retirement. My name is Robert Kuhn, president and founder of Kuhn Capital Partners, headquartered in Oak Brook, Illinois. We're right across from the mall. We do have a large client base, though, from the advisory side to the private fund side. We are working with individuals in around 24 states. We advise on or manage directly close to $200 million. That number is rapidly increasing, and I think that is a direct representation of our ability to educate, our ability to have conversations with investors on strategies that are commonplace for the advisor, but maybe not so commonplace for you, the investor, because they're not mass marketed. So if you haven't had your financial plan updated, if you want to look at RMDs and the tax benefits that you're going to have to ultimately pay and model those out to age 95 and see if there's strategies that can take advantage to reduce those RMDs through a Roth conversion, especially if you have a multi-seven-figure IRA. We can have those conversations. So 630-492-1912, 630-492-1912. Berkshire is a great company. We talk a lot about, Berkshire, at least we have internally, and we certainly do with clients. And we saw a chart the other day that Berkshire Hathaway is sitting on an all-time high. Now, they could have put it all to work. I mean, this is, as of the middle of May, so certainly we don't get alerted or updated when they put that to work. But at that time, they had almost $400 billion in cash. And I thought it was fascinating that was enough to buy 478 companies in the S&P 500. I mean, think about that, 478 companies in the S&P 500. And I just thought, wow, there's just a lot of cash on the sidelines. And so many of these individuals, advisors that, talk with clients and share, asset allocation strategies with clients. I mean, they really just do, in my opinion, a disservice to investors by just leaning on, 100 years worth of market data. I mean, the markets are expensive. The markets are absolutely, historically speaking. I mean, I earlier in the show, I gave you, a couple statistics that, certain measurements on how you look at the market, of course, but one that we follow pretty closely. I mean, the markets are now the most overvalued in 50 years. But does that mean that the markets are going to drop? Does that mean that you should sell everything? Does that mean that, just because they're overvalued today, that we can't have another 3, 5, 7, 10-year run in the market? Absolutely not. I mean, there's, it seems like the market's defying gravity. And one of the ways that we look at asset management is, again, when you look at, kind of just simplifying it, right? We want growth. I mean, everybody wants, I think, some sort of growth. We want, protected growth as well. And we say protected growth because the banknotes, have that level of protection. The banknotes, we did the mini Mag 7, which was a Mag 3. We did Amazon, Google, and Meta, that priced at 22%. Again, as long as those stocks, neither of those stocks goes down 30% from the date the note trades. Each month they look at it. They just simply look at it from, so let's say hypothetically it traded today. Every month they're going to look at it. And as long as those stocks aren't down, and it just takes one, but as long as none of those stocks are down 30%, then you get your, almost 2%. You just take 22 divided by 12. And so there's a lot of individuals that want some level of downside protection, but yet still want to have some names or some strategies that can really grow. And 22%, I mean, even if you missed half So let's think about that. If you missed half of the coupon payments for the year, so that means that those stocks, one of them would had to have been down and stayed down over 30%, and you only, for 6 months, and you only received half of the coupon payments, well, you still made almost 11%. And I was reading an article that the SEC or FINRA, one of the governing bodies, is making sure that the banknote strategies, they call them structured notes, but structured notes are kind of like saying cars. I mean, there's good cars, bad cars, et cetera. But you just have to make sure that there's disclosures. And it's like, I'm thinking to myself, we over disclose everything. And when you look at what the banknotes are, I mean, we put it right on our website for you to watch, how you get paid, how you don't get paid, who the banks are, the credit, everything. And candidly, they're rather simplistic. I mean, it may take you a few times to understand it, but they're rather simplistic for the return. And I always encourage listeners, if you're just being sold the same thing, 60-40, 70-30, 80-20, whatever, using fixed income as a means of portfolio diversification, which is your quote unquote safe money. I mean, how has that done for you? Again, I haven't looked at this in it's been at least a month now, but the AGG was annualizing at under 2% for 10 years. I mean, we really have been, by many measures, in a bond bear market. But yet advisors are still doing what's easy and still doing what's easy for them. And if you're getting tired of that type of a strategy, if you want some growth, if you want some real, concentrated growth for 5 to 10% of your money, 15% of your money, I mean, we have those strategies. If you want to take advantage of, the energy strategy to greatly reduce your taxable income, active or passive. Again, I have to always give you the disclaimer that we can't provide tax advice. So, best practice is to always bring in your whoever you're getting your tax advice from, but energy provides significant tax benefits. And I understand why people are reaching out now because, the radio show, we've been educating for so long that obviously helps. But, people are just tired of the same old. People are tired of the advisors, still, just giving, the same strategies that were available in the 80s and 90s. And it's just not the case anymore. And it should not be the case. You should at least have educated conversations about strategies that have some level of defined outcome, some tax strategies, some, concentrated growth strategies, and then your typical growth. I mean, goodness, we don't even talk about our growth strategies, third party managed by, a manager that has just a phenomenal, historical track record. Again, it doesn't mean anything because it's past performance. And as you know, past performance is not indicative of future results. But when you compare that to the S&P, people and advisors and clients need to start, focusing on performance. And it's something that we want to shine a light on because I think it's a competitive advantage. So 630-492-1912, 630-492-1912. Check out the website, KUHNCP.com, KUHNCP.com. And we certainly would love to hear what you're doing and answer any questions you have. I saw another great statistic. A 20% gain in the S&P tech sector in 4 weeks has only happened 3 times in 100 years. So how much, think about that. So let's go back before this happened. If I told you a 20% gain in the tech sector in 4 weeks has only happened before this one 2 times in the last 100 years, what would you think? Well, it's never going to happen. Well, it can't happen again. Oh, it's too good to be true. Well, it happened in 2026. Now, the first 2 times ended badly. And, obviously, the markets did drop. And the third just happened. And so the market is a great teacher. It just charges a very high tuition for the same lesson. And I don't put that on you. I don't put that on you unless you're the one making the investment decisions. I put that onto the advisor for lack of education, lack of defensive type strategies. So many advisors here, an advisor at another firm and who's a buddy with an advisor at my firm, and they went out for dinner. And inevitably it's, what are you doing? Blah, blah, blah. And, my advisor said, well, we're doing a lot of banknotes and structured notes. Oh, those are terrible. Those are so terrible. It's like, what in the world? A, he couldn't articulate what they were, which is 9 out of 10 advisors, unfortunately. B, what makes something, and here's the problem with the industry. Unless the idea was brought to you from your advisor, they're going to poke holes in it. Why? It's self-preservation. They want to keep you as a client. So they're going to poke holes in it. And I think the job of any advisor, especially an advisor like us that looks at, defined outcomes, looks at strategies that, I can't tell you how many people are so comfortable knowing that, okay, I get X if Y doesn't happen. And if it takes you 10 months or 10 days or 10 minutes to fully understand it, guess what? We're going to be there to educate you. Watch the videos, read the prospectus. Let's go over hypotheticals. And, it's just the problem with this industry is, advisors are always in self-preservation mode. They try to convince clients that something that was, readily used institutionally or family office or private bank place or private bank strategies, advisors, et cetera, is a bad strategy because they did not bring you that idea. And that's a problem. That is absolutely a problem. And it's something that we try to hit head on. And again, it's just who we are, what we are, and how we are. And I think, people feel comfortable with us because of the educational nature of what we're doing. We're not here to talk over you. We're not here to tell you that we're smarter than you. We're not here to tell you that, we have the best way of everything to do. Our job is just to tell you, here are some investments out there that work really well together. And, obviously with the banknotes, many people like double digits with 30% downside backed by the largest banks. Currently, they're pricing 12, 13, 14%. And those are the income type notes. And the growth note, the Meta, Amazon and Google, that priced at 22. Again, there's downside. You've got 30% buffer before those, you don't get paid your coupon. So I encourage you to, especially in this market, to make sure that you have some sort of downside protection or some sort of, growth type strategy, like the energy strategy, for example. That revenue from the oil and gas wells, which are in the Permian, operated by what I would consider to be the biggest and best, the Exxon, Chevrons, Conocos, Matadors, Mewbournes of the world. That income is coming in no matter what happens in the S&P. And that is just a beautiful, beautiful thing. And again, that type of asset allocation is so basic. It's just not seen, unfortunately, in the, million to kind of $15 million space. So KUHNCP.com, KUHNCP.com. Check us out on the website. If you'd like to schedule a call, it's 630-492-1912. 630-492-1912. More after the break.
Planning for retirement is kind of like planning for a trip of a lifetime. First you save and plan every detail. Then comes a day you've looked forward to for so long. Preparation is the foundation for successful travel and retirement. At Kuhn Capital Partners, we believe that foundation is a financially secure and tax-efficient plan that seeks to protect your needs now while looking to the future. Reach out to Robert Kuhn at 630-429-1912 and visit our website, KuhnCP.com.
Welcome back. You're listening to Destination Retirement. My name is Robert Kuhn, president and founder of Kuhn Capital Partners, independent SEC registered investment advisory firm. SEC doesn't mean we've attained any level of success. It just means we manage the certain amount of money that we have to register with the SEC. So it's always important for transparency purposes. When I say those things, it's just something that we believe in: radical transparency. Always have, always will. Good or bad, we want to share, with you, like especially when it comes to investing, right? Strategies. And I just get so tired, so tired of advisors that put down investment strategies because they're afraid of losing the client and they don't have access to or didn't bring that strategy to the client. But keeps us in business, keeps our passion level high. our passion bucket filled, as they say. So 630-492-1912. 630-492-1912. Or check out the website, kuhncp.com, kuhncp.com. You know, for those investors that are looking at those lifetime income annuities, I'd love to find a statistic, and I don't know if it's out there, and if you're being sold one or if you were sold one, I'd love for you to share with or ask the advisor rather, what percentage of clients or investors from that insurance company are actually receiving a benefit from the lifetime income. And what I mean by a benefit, I mean it's really simple. You're only taking your own money out of that account until it goes to zero. That's it. Now you have that guarantee, sleep at night. You know, we can never run out of money, but you are only dollar cost averaging out of that account. And when that account goes to zero, if the growth that they promised doesn't overcome the withdrawals, then the account will go to zero. And then, yes, your income is still going to continue. But my opinion is they give you just enough growth and then they meter how much you can take out, that actuarially there's probably it's highly unlikely that your account's going to go to zero. And I want to see if there's a study out there that shows, of all of the lifetime income annuities that were purchased, how many of the accounts have gone to zero, and those investors are actually then getting a quote unquote benefit of that lifetime income. Because the reality is, inflation is ripping, and it just is. I mean, these are the numbers, and I get very concerned, you know, putting so much of their money in their portfolio in a lifetime income story, and it's just not going to keep up with inflation. New cars, 20%, groceries, 26%, health insurance, 27%, shelter, 30%, restaurants, 30%, home prices, 37%, electric, 39%. I mean, it just goes on and on and on and on. And that's over the last 5 years. And it's just a challenge. And it's a challenge that I think, you know, most people are going to have an issue with, especially if it's, you know, something that, you know, you put, you know, an overweight of your portfolio in. I strongly consider or suggest rather that you really take a look at, you know, the bank notes, because any way you look at it, if you need immediate income, again, there is a level of equity risk, of course, in the bank notes. Even the index note strategies that we do, we usually will do, you know, tier 1, tier 2, which is all the major indexes that we will combine, but you have 30% downside of those indexes before you don't get paid in a month. Now it's 30% from the date of issue. So if we issued it today, you know, they're going to look at it, at least for the first 6 months, you're going to own it, because we do not callable for 6 months. You're going to own it for 6 months. And as long as on that monthly valuation that the indexes aren't down 30%, you're still making money. You're still getting your coupon payment. So if you need immediate income, and we're looking at double-digit, you know, yields or double-digit coupon payments, I mean, that's pretty strong, right? Pretty darn strong. And if you don't need it for 5 to 7 to 10 years, think about the wealth that can be created if you just roll over those notes. And again, it's not 100% of your money. You know, generally we will use that as a bond alternative. And so it may make up 10%, 15%, 50%, you know, whatever of your portfolio. But again, the defined outcome strategies, they're not new. It's just most advisors don't use them. They don't know how to use them. They don't know how to articulate them. They've never grew up doing them. I just happened to be, you know, a young buck. I wasn't a young buck. I mean, maybe I had, maybe 5-6 years of experience when I started doing them, you know, in the early 2000s. But they became second nature to us. And when you do the amount of volume that we do, which I believe we're over 100 million over the last 18 months, I think year to date, we're pushing 40, 45 million. It's a lot of work. It is a tremendous amount of work because as they get called, which they frequently do, you know, based upon how they're structured, you have to do another note. 630-492-1912, 630-492-1912 if you'd like to have a conversation, if you'd like a second opinion, if you'd like a income plan done, or if you'd like to stress test your current portfolio, if you'd like to stress test your current income plan. I see so many people, you know, living on still on this 3%, 4% withdrawal rate. And goodness, I mean, And it's something that we challenge. Again, it's very easy to sell. It's very easy to market. It's very easy to run on a commercial. But, we go back to kind of that advisor that believes you just buy and forget it. It just doesn't make sense to me that if you're telling a client to sit 70-30, S&P type stuff to fixed income type stuff, what's the point of the advisor? Seriously, what is the point of the advisor? Because there is something called a fee drag. If you're paying 1%, 2%, whatever that fee is, that adds up over time. And if you're not receiving a benefit from that, everybody thinks they're receiving a benefit when the markets are up. Well, newsflash. Unless you're in a concentrated, portfolio like our hedge fund strategy that we really want to get after it when the markets are up. But what value is an advisor bringing you? You could have pretty much done that on your own. And so an advisor talks about those strategies, when they talk about the fact that 100 years worth of market data, blah, 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 the markets always go up. Of course they do. Nobody is debating that. 3 out of 4 years, they're going up. It's just what are you benchmarking it to? What level of success are you saying that my advisor, brought value or didn't bring value? And then when the markets are down, it's inevitably, we'll just sit and wait. It's going to come back, which, generally has been proven to be true. But again, why am I paying you? Why am I paying you? And the beautiful thing is that you're paying us for the banknotes. You're paying us to give you access to those banknotes, where most advisors don't have access to off-the-shelf banknotes. We do custom banknotes. We do volume that we're going to get when you give Goldman Sachs $5 or $6 million for a single banknote, they're going to give you a better yield than an advisor giving somebody $250,000. That's just the way that they work. And so you are paying us for having strategies that, again, as long as the markets don't drop 30% or whatever that buffer is, you're going to get paid and on a monthly basis. That's why you're paying us. Generally we charge 1.25% for those, or if you hit a break point, we charge 1%. And some people balk at that price, and it's like, okay, don't do it. If you're getting 12 to 13% with a defined outcome when the markets are still down 30 and you're still or not down 30, but could be down 25 and you're still getting paid, and you don't see value in paying, 1 to 1.25% for that, well, then I guess you don't want to work with us. And, you look at, the energy strategy. We're talking significant tax reduction, significant. $80,000 to $90,000 is the target for every $100,000 invested to reduce active or passive income. Again, we're not tax professionals. Bring in your tax advisor. That is a best practice. Google it, AI it, whatever you have to do. But energy investing in the private fund space is, in my belief, the best tax advantage strategy that you're ultimately going to find. And it's, that's why people are paying us. And, the hedge fund strategy is what it is. And, again, dollar cost averaging is a beautiful thing, but most people will acquire, certain investments, certain stocks. And yes, a lot of people want to wait until the markets go up before they get quote unquote comfortable. Well, they buy at the high. Well, the benefit of working with a fund is that as long as we have capital coming in, of course, if we have no capital coming in, we can't buy, new names. And as long as, or make additional allocations, and as long as we still believe those stocks are, fit our criteria to own, we can dollar cost average in on your behalf. And that's just a beautiful thing, because the markets will go down, and they will go down significantly. And if you are in a buy and hold strategy that only uses equities, only uses fixed income, it's probably going to create a level of stress that ultimately you just don't need to have, in our opinion. So if anything I said resonates with you on this radio show, you know how to get in hold of us. But I'll tell you again, it's 630-492-1912, 630-492-1912, or check out the website, KUHNCP.com, KUHNCP.com. Hopefully everybody's enjoying late spring, early summer, but it is Chicago, so but hopefully the cold days are gone. So more next week.
This recording is for informational purposes only and should not be considered investment advice. Kuhn Capital Partners does not provide legal, accounting, or tax advice. Any statement regarding such matters is explanatory and may not be relied upon as definitive advice. Opinions expressed are current as of the date of this recording, and such opinions are subject to change. The views and opinions of guests on this program are not necessarily those of Kuhn Capital Partners. Any reference to guarantees, principal or income, protection, buffers, or defined outcome investments are generally structured notes or fixed insurance products backed by the claims-paying ability of the offering company and are not insured by any government agency. Kuhn Capital Partners is not affiliated with any guest unless otherwise stated and does not guarantee the accuracy or the completeness of any data presented. Kuhn Capital Partners and its affiliates are not responsible for any trading decisions, damages, or other losses resulting from or related to the information, data analysis, or opinions in this recording. Past performance is not a guarantee of future results. All investments are subject to investment risk, including but not limited to the potential loss of principal. Advisory services are offered through Kuhn Capital Partners, LLC, a registered investment advisor.